Germany just demanded 113 billion euros worth of gold back from American vaults. Sweden dumped $8.8 billion in US Treasuries. Denmark announced that it is exiting US government bonds entirely, with their chief investment officer stating on the record, "The United States is basically not a good credit." This is not a hypothetical scenario anymore. This is the moment financial analysts have warned about for years, when America's allies finally decide the risk of holding dollar assets outweighs the benefits. We are watching the beginning of a coordinated European withdrawal from US financial assets that could trigger the exact dollar crisis everyone said was impossible. The taboo has been broken. The illusion of the risk-free asset is dead. Welcome to the Dollar Watch. Let's look at the numbers. Here is the context that makes this extraordinary. For decades, storing gold in New York and holding US Treasuries was not just safe. It was the definition of safety. After World War II, Germany built up the world's second-largest gold reserve and stored much of it in the vaults of the New York Federal Reserve. The logic was simple. In case of a Soviet invasion, Germany's wealth would be protected in American vaults. That arrangement persisted long after the Cold War ended, even when a grassroots movement in Germany demanded repatriation in 2010, the Bundesbank resisted. They trusted the US Federal Reserve more than they trusted their own vaults. Between 2013 and 2017, Germany did bring back 674 tons from New York and Paris, but then the process stopped. Roughly 1,236 tons, about 37% of Germany's total reserves worth 113 billion euros, remain in Manhattan. The same pattern held for US Treasuries. European investors kept buying American government debt because it was the ultimate safe haven. Denmark's Akademiker pension had used US Treasuries for liquidity management for years. Sweden's Alecta held around $11 billion in US government bonds. These were conservative institutional investors doing what conservative investors do, holding the safest assets available. And then something changed. Within a 48-hour period this week, all of that stability shattered. Let me walk you through what actually happened, because the financial mechanisms here matter. On Tuesday, Denmark's Akademiker pension announced that it would exit US Treasuries entirely by the end of January. Not reduce holdings, not rebalance, exit completely. Chief Investment Officer Anders Schelde told Bloomberg, and I am quoting here, "The US is basically not a good credit and long-term the US government finances are not sustainable." On Wednesday, Sweden's Alecta revealed that it had been quietly selling US Treasuries throughout 2025, offloading between $7.7 billion and $8.8 billion worth of US government bonds. Chief Investment Officer Pablo Bernengo cited the reduced predictability of the policy pursued in combination with large budget deficits and growing government debt. Then on Thursday, senior figures in Germany's Christian Democratic Union, CDU, the party set to lead the next government after February's election, began openly discussing full gold repatriation. Marie-Agnes Strack-Zimmermann, chair of the European Parliament's Committee on Security and Defense, publicly demanded Germany return all gold reserves from the United States, specifically citing the unpredictability of the policies pursued by the administration of Donald Trump. When you analyze geopolitical patterns, you learn to read coordination. These were not isolated decisions. These were announcements made within 48 hours of each other, all citing identical reasoning. American fiscal instability combined with political unpredictability. Here is the financial mechanism that matters. Europe collectively holds approximately 3.6 trillion euros in US Treasuries. That represents roughly 40% of all foreign holdings. Beyond that, European investors hold roughly $8 trillion total in US bonds and equities. If even a fraction of that capital starts flowing home, US borrowing costs spike. The dollar weakens even further, and global financial markets destabilize. The Danish pension fund's $400 million exit doesn't move markets on its own, but it sets a precedent. And when Sweden reveals $8.8 billion already sold, and Germany starts demanding $130 billion in physical gold, You are no longer looking at isolated decisions. You are looking at the early stages of capital flight. For years, analysts warned about over-reliance on dollar assets. Nothing changed. The inertia was too strong. The alternatives were not compelling enough, and the risk seemed theoretical. But recent events made the risk concrete. The threats regarding Greenland, the attacks on Federal Reserve independence, the tariff wars against European allies, all of it transformed what if America becomes unreliable from a hypothetical scenario into observable reality. So what are the actual consequences of this shift? First, understand the amplification dynamics. Japan's bond market is under severe stress, with yields on ultra-long 40-year debt surging above 4%. That is the highest level on record. When yields rise at home, Japanese investors, among the largest holders of US Treasuries globally, have a rational incentive to repatriate capital. This is not panic, this is yield-seeking behavior. But it drains liquidity from US bond markets exactly when European investors are also pulling back. Second, look at the historical precedent. Germany's current gold repatriation discussions mirror what happened in the 1960s under Nixon. Back then, Germany, France, and Switzerland redeemed gold reserves because they feared the US wasn't maintaining dollar integrity. That redemption wave contributed to the collapse of the Bretton Woods system and triggered chronic inflation throughout the 1970s, alongside a massive gold rally. The parallels here are striking. Third, and this is what most analysts are missing, this validates the strategy central banks have been pursuing for years. We have covered extensively how central banks have been accumulating gold at a record pace. According to the World Gold Council's latest surveys, 43% of central banks globally plan to increase gold holdings in the coming year, a record high. They were not buying gold because they expected stability. They were buying gold because they anticipated exactly this moment. The official reasoning from European institutions is very careful. They cite fiscal concerns, budget deficits, debt sustainability, all true things. But when you analyze the timing, announcements coming within 48 hours of each other, all during the same week Trump escalated Greenland threats and intensified attacks on the Federal Reserve, the pattern suggests coordination, or at a minimum, herd behavior triggered by a common catalyst. Treasury Secretary Scott Bessent's response at Davos was revealing. When asked about European divestment, he dismissed Denmark's holding as irrelevant and said Denmark itself is irrelevant. But that completely misses the point. The dollar amount doesn't even matter. The precedent matters. If conservative European pension funds can publicly announce that US government finances are unsustainable and American credit is unreliable, then every other institutional investor globally is now permitted to ask the very same questions. The taboo is broken. Once the first domino falls, the rest follow not because they want to, but because their fiduciary duty demands it. So what happens next? First, I would watch for Italy. Germany and Italy combined hold roughly $245 billion worth of gold in US vaults. If Germany's CDU follows through on repatriation after February's elections, pressure on Italy's government intensifies. Meloni's Brothers of Italy party pledged in 2019 to bring Italian gold home. That promise went quieter after taking power, but this German move could revive it. Second, watch the pension fund cascades. Denmark's PBU pension fund told Danish broadcasters TV2 it is also selling US bonds, explicitly stating, "We want to free ourselves from our dependence on the United States in case Trump decides to impose sanctions directly targeting the Danish financial sector." When institutions start divesting not because of yields, but because of sanctions risk, you are no longer in normal market dynamics. You are in capital flight. Third, and this is the prediction most people will miss, watch for this to accelerate America's own policy mistakes. When foreign demand for treasuries weakens, borrowing costs rise within the US. When borrowing costs rise, fiscal pressure intensifies. When fiscal pressure intensifies, the temptation grows to politicize the Federal Reserve or pursue monetary financing, money printing. Those actions further undermine credibility, driving more capital flight. It is a self-reinforcing cycle. The beautiful irony is that US actions are triggering exactly the loss of confidence the administration claims to want to prevent. Every Greenland threat, every attack on the Fed, every tariff escalation with allies teaches global investors the same lesson. American policy is no longer predictable, and dollar assets carry political risk that was not priced in before. For decades, the dollar's dominance rested on a simple premise. America might be chaotic domestically, but it remained a reliable steward of the global financial infrastructure. That premise is now being tested in real time with real capital movements. Germany wanting its gold back is not just about 113 billion euros. It is about whether the post-World War II financial architecture, where America holds the world's wealth and the world trusts America to return it, still functions. Based on this week's announcements, the answer to that question appears to be shifting. Let's talk about the liquidity trap this creates. If Europe stops buying treasuries, and Japan stops buying treasuries, and China is already selling treasuries, who buys the debt? The US government is running a $2 trillion annual deficit. They need to issue trillions in new bonds every year just to keep the lights on. If the foreign buyers leave, the Federal Reserve has to step in. They become the buyer of last resort. That means restarting quantitative easing. QE. That means printing money to buy the government's own debt, and that leads to inflation. This is why gold is hitting all-time highs. The market is sniffing out the end game. The market knows that if foreigners stop funding US deficits, the Fed has to monetize the debt, and monetizing the debt destroys the currency. Germany knows this better than anyone. They lived through the Weimar hyperinflation. They know what happens when a government prints money to pay its bills. That is why they want their gold back. We are entering a new era of sovereign risk. For 40 years, risk was something that happened in emerging markets. It happened in Argentina, or Turkey, or Venezuela. The US and Europe were risk-free. That era is over. The actions of Denmark, Sweden, and Germany this week prove that sovereign risk has arrived in the G7. When a Danish pension fund says the US is not a good credit, they are repricing the entire global financial system. You need to pay attention to this. This isn't just geopolitical noise. This is the sound of the tectonic plates shifting. If you hold US assets, if you hold dollars, you are holding the liability of a government that its own allies no longer trust. Germany is demanding its gold. Sweden is selling its bonds. Denmark is exiting entirely. The smart money is moving. Are you? Subscribe to the Dollar Watch. We'll see you in the next video.